Well, I think the geopolitical risks are more of a canard. In fact, gold fell by about $50 today. And I think the catalyst was the belief that, oh, the geopolitical risks are not as bad. We had this retaliation. Israel was very limited, and maybe that's it. And so things are going to be settling down in the Middle East. And I think that prompted a lot of speculative selling in gold. But I don't think the geopolitical concerns have been the main driver of this rally. And I believe the real buyers are going to step back up as a result of this $50 pullback, and they're going to buy more gold and drive the metal to new highs. What's driving gold higher is inflation and the understanding that it's impossible politically for the Fed to actually stop inflation, that inflation is actually the lesser of the two evils in the Fed's mind. And so rather than a winning inflation fight that would cause a severe financial crisis and force the US government to default on its debts and cut spending, the Fed is going to monetize debt and buy bonds and do whatever it takes to prevent those political choices from having to be made. And so inflation is going to be much higher than 2%. And that means gold needs to be much higher than its current price. And I also think that a lot of the central banks can read the writing on the wall. I mean, in many cases, they put the writing on the wall so they understand it, but that the dollar's days as the world's reserve currency are numbered, and the replacement for the dollar will be gold.
In a recent analysis by Peter Schiff, the $50 drop in gold prices is attributed to easing geopolitical tensions rather than being the primary driver of the rally. Schiff emphasizes that inflation concerns remain paramount, with the Federal Reserve likely to prioritize debt monetization over tackling inflation head-on. He underscores the increasing role of gold as a hedge against currency devaluation, especially as central banks continue to diversify reserves away from the dollar. Schiff also criticizes the significant spending packages, warning of a mounting fiscal crisis exacerbated by unchecked government borrowing.
And so central banks, seeing the vulnerability of the dollar and understanding that its reign is coming to an end, they are trying to replace dollars in their reserves with gold. And they have been big buyers of gold, and they will continue to be buyers for years to come. I think some of the speculative, so if you're looking at the futures traders, certainly some of those traders got into it for the geopolitical aspect of it. But the real buyers that have been bidding up the prices are not the futures traders. And the real buyers are buying it for other reasons, not the reasons that commodity traders might be buying or selling it on any given day. I mean, most people who are in the futures market have taken delivery of any of that gold. They're just trying to speculate on short-term price movements. And if they think those price movements are defined by geopolitics, then that's what they're trading on. But the fundamental factors that have lifted gold to 2,400, right, 20% above 2,000, have nothing to do with that. And gold's going to keep on rising because the dollar and the euro and the yen and the pound are going to keep on losing value. Because, all these central banks are not going to raise rates high enough to put the inflation genie back in the bottle. And so you need an alternative to fiat currencies. And the only monetary alternative is gold. The bill that was passed, another $95 billion spending package, $61 billion to Ukraine. And the Ukraine has already received upwards of $100 billion. So, this is a tremendous amount of money that is going to the Ukraine with no end in sight. Who knows? Maybe we'll end up sending $1 trillion to the Ukraine over the years. But this money is being borrowed. We have a ticking fiscal bomb here. And rather than diffusing it, we're just, making it worse. We're adding more debt. There was no discussion about whether or not we needed to pay for this aid, whether spending should be cut somewhere else in the budget or taxes should be raised. No, there's no consideration to where the money is coming from. Let's just spend it and we'll just run up the debt, completely oblivious to the debt crisis that is already looming, and we're making it worse. But it really sends a signal to the markets that Congress doesn't care. The deficit, the debt doesn't matter. The fact that we're spending over $1 trillion a year on interest doesn't matter. The fact that next year we'll be spending $2 trillion a year. That means interest on the national debt will be the single biggest line item in the federal budget. We'll be spending more on interest than we do on either Social Security or Medicare. but no one seems to care about this. And that trend is only going to accelerate until eventually 100% of tax revenues will be earmarked to pay interest on the debt.
Continuing his analysis, Peter Schiff emphasizes that the recent surge in gold prices reflects a resounding message. The Federal Reserve's monetary policy is misguided. Despite widespread anticipation of rate cuts, Schiff argues that what's needed are rate hikes to combat inflation effectively. He underscores that gold's ascent signifies broader concerns about loose monetary policy and impending inflation, a message he believes is being overlooked by many. Schiff predicts further declines in bond markets, driven by eventual quantitative easing measures that will depreciate the dollar's value, with gold's record highs signaling currency devaluation.
Gold's rise is signaling that the Fed policy is wrong, that the Fed is making a mistake in its contemplation of rate cuts. In fact, the Fed has not raised rates enough, and we need more hikes. But they've practically, or for all intent and purposes, taken those hikes off the table. Nobody expects the Fed to hike. The only expectation is, when are they going to cut? How many times are they going to cut this year? When are they going to start? But the conversation should be about hikes, but we're not getting those because, the Fed knows that the economy can't handle the higher rates. They can't even handle the rates that exist today, which is why the Fed wants to reduce them. So gold is sending a loud message. It's falling on deaf ears, but it's sending a message that monetary policy is too loose and that the Fed and other central banks need to raise rates, but they're not doing that. And it's also sending a message that inflation is going to be much higher than is generally perceived by investors. So I think the bond market has been selling off, but I think the bond market is still mispriced because they still think that Fed, quantitative easing program, when it eventually resumes, is potentially going to save the bond market. But I think it ultimately dooms the bond market because those quantitative easing programs destroy the value of the dollar, which is what the bonds ultimately promise to pay. So the bonds are only as good as the dollar, and a return to QE and skyrocketing inflation just assures the dollar is going to collapse in purchasing power. I mean, I think bonds are headed lower. I think the dollar ultimately is headed lower. I mean, it hasn't really started to fall yet, although it is falling. Gold tells you that the dollar is falling. It's just falling more slowly than the pound or the euro or the yen. But all these fiat currencies are losing value. Gold on Friday closed at a record high in every currency in the world. And it pulled back today, but that's, no big deal. I mean, that's what happens in a bull market. You get a drop that scares out, the weaker players, the leverage players. But, there's no indication that the gold price is going to stop rising. And I think eventually it's going to rise much faster when the public joins the buying and even professional investors. There's very little institutional demand in the gold market. It's mainly coming from abroad. And a lot of it is coming from central banks, particularly emerging market, Eastern central banks. The West is not buying, right? The Fed, the European Central Bank, right? The Bank of England, they're not the ones that are buying the gold. Well, it's like, emerging markets, China, India, smaller Southeast Asian countries, they're buying. Probably some South American countries. And countries that have a lot of US dollar reserves that they need to, get rid of. So they're selling their dollars and treasuries and buying gold. And, they could get 5% yield on their treasuries, but they're willing to give that up to own gold because they recognize that that yield is not high enough to offset inflation. I mean, if you measure the purchasing power, prices are going up. So dollars today buy a lot less than they did a year ago. So the dollar is losing purchasing power. It's just that when we typically think of the dollar, we think of it relative to another fiat currency, whether it's the euro or the yen or the pound. And if we see that the dollar has gone up relative to those currencies, we conclude the dollar is going up. But, if I'm in a car going backwards at 5 miles an hour and the cars next to me are going backwards at 10 miles an hour, sure, relative to those cars, it appears that I'm going forwards, but I'm actually going backwards. And so gold is what's telling you all the currencies are falling in terms of gold. The dollar is just falling less than other currencies for now. I think that is going to change. I think at some point the dollar is going to start to fall more. And when that happens, you're going to start to see a much bigger dollar rise in the price of gold. But I think one of the reasons that falling bonds are somehow supporting the dollar for now is that as bonds fall, yields rise. And
Exactly.
those higher yields are attracting dollar buying. People think, oh, higher yields are good for the dollar. Bond yields are rising, so let's buy the dollar. But I think bond yields are rising because of inflation. And inflation is bad for the dollar because it means the dollar's value is going down. And it means bonds are losing value because bonds are promises to be paid dollars at some future date. And the further into the future you're going to get paid, the more bonds should suffer due to inflation. So a 30-year treasury should lose a lot more value because of higher inflation than a 1 year, because you have 29 more years of inflation to erode away the value of your principal.
Today's discussion with Peter Schiff shed light on the complex factors influencing the gold market. While geopolitical tensions may have temporarily impacted gold prices, the underlying drivers remain inflation and central bank actions. Peter emphasized that the Fed's reluctance to combat inflation and the escalating debt crisis are key catalysts for gold's continued rise. Moreover, the growing recognition of gold as a hedge against currency devaluation is driving demand, particularly from emerging markets and central banks. As we wrap up, remember to subscribe for more insightful discussions like this video and share your thoughts in the comments below. Thank you for watching.